Welcome to Key Points for September. This month, our take on the V-shaped recovery in economic data and whether it's sustainable, our view on the slight change to the Fed's mandate of its inflation target, and as always, where we think financial markets go from here. Now, turning to our first point, there is no doubt that economic data over the summer period has been very strong, really allowing an optical V-shaped recovery that we had been predicting for some time. The question is this sustainable? Now, we suspect that growth will slow down somewhat, but we do believe that the track is still for the recovery to remain in place. What is critical is a lot of the support mechanisms that have allowed that recovery to take place need to remain in place. Some of them are already maturing, particularly in the US and some places in Europe as well, but we need to see further fiscal and monetary support to allow that recovery to keep the trajectory going forward. Now, we are a little bit concerned about the pickup in terms of the COVID infection rates, particularly around Europe, but the dynamic within that seems to be a little bit different in terms of the demographics that are showing the virus itself, but also hospitalization rates remain low, as do death rates. So again, we're encouraged by that, and we're not predicting a further national lockdown that we saw at the spring period of this year. Now, turning to our second point, the Fed has altered its inflation mandate a little bit. They had always a target of having a 2% core PCE in the United States. Frankly, over the last decade, they've really failed to miss that consistently. But they have a new revised average 2% target, implying that they will allow inflation to be a bit above target for a period of time, although they haven't disclosed exactly what that period of time is, nor how much they'll allow that to breach that 2% target. But we are encouraged by this, but it also implies that they will allow the economy to run a little bit hotter for a bit longer. In other words, keeping interest rates low to allow inflationary forces to begin to pick up and achieve and breach that target. So encouraging, but still a lot of work to do given that they were unable to meet that target over the last 10 years, and keeping an average at that level may prove equally troublesome. Now, turning to our third point, financial markets. Well, both equities and credit markets have been extremely strong over the summer months. In the case of equity markets, many new highs are now being reached, and we believe that that uptrack can remain in place. The pace is likely to slow, and frankly, we would like to see a period of consolidation, a broadening out of the drivers of these markets in order to give a firmer platform to allow further upside. But there is no doubt that the move that we're seeing, driven by liquidity, as I mentioned, with interest rates being held low and momentum more broadly, is encouraging. Credit markets have benefited from default rates, frankly, being lower than a lot of analysts had expected. Earnings have been surprised positively, and even dividends have been maintained in a constructive manner. So broadly, we still think there's upside for both equities and credit, although a period of consolidation would be welcome. Remember, as always, you can read our Investment Insight report along with all our other documents on zurich.com/MSME.